Victor, is volatility a better play than the directional in the market? Is both sides the right play, or bonds the right play? Bonds at the low end of their range in this most recent
I think
move.
bonds are on. You think bonds on balance are cheaper than stocks?
That's what I'm saying. That's what
I mean, what do you think? I'm asking you the question.
Me, I'm the world's worst commodity trader.
Don't give me any of that crap.
I know, but I'm going to give you my opinion.
I mean, I would say you're the world's worst trader, but are you? I mean, what's cheaper? Like, how can you be a bad bond trader? You're a bad stock trader. I mean,
am I an average option trader? Can I get something?
That's so unfair.
You're
That's
an
so not
average
true.
human.
I'm an average human.
Yeah,
I appreciate that. I appreciate
You're
that.
the average of the people you surround yourself with. Have you ever seen the people you surround yourself with? They're average.
Are you included in that?
No.
No.
I'm outside. I'm in a different group.
Got it. You're in the special group.
Special group. I'm with the special children.
I mean, just because of bond pricing, I would say that bonds are probably a better buy than.
I mean, so you think bonds are cheaper on balance than
relative.
stocks? What do you think, Vic?
I'm leaning long bonds. I am net portfolio, net long delta, but I'm not like jumping out of the window to go crazy long, but I'm net long delta. But I think I hate bonds. I haven't wanted to be long bonds. I think this move down to 112 and change with an already established low from 3 sessions ago, I think you got something to trade against at that previous low. And so I'm taking a very small stab at long deltas and ZB, even though I sort of hate them. What do you think, Tom?
So you think that? So you think stocks are cheaper than bonds here still?
I think stocks are cheaper than bonds. I'm leaning long both, is what I'm telling you.
Okay, that's fine. I guess I'm leaning long both too.
I would say me too on a net balance.
You too on a net balance.
Yeah, but
Which one's cheaper? I would say bonds are cheaper.
velocity.
I think bonds are probably cheaper. Given the rally in stocks at 5,300, we're at 5,000. Maybe I changed the answer. I'd probably say bonds are a little bit cheaper than stocks right now.
Well, it's funny because the three of us are leaning long in both bonds and stocks, which means we're dead, guys.
Yeah.
We're absolutely
dead.
Yes,
so dead.
I think we are. I think
we're
there's
dead.
More movement to the downside.
Yeah, I mean, I really thought that bonds got to a point where they were, where not that they were so. I thought that they kind of capitulated based on implied volatility. But I have never seen a bond crash before, so it's kind of hard for me to say, with 100% certainty, what does that look like? We've seen kind of bond.
We got through the auctions. We got through the 10 and the 30-year auctions.
We've seen meltdowns.
We got a CPI that was cooler than expected. And the interesting thing is you get a cooler than expected CPI, and you don't get your first order read through, which would be a bid in bonds. But I don't know. I like you got a tradable low against both of those assets, and I like taking a little stab on both. And I'm going to ask you this question, Tom. Do you think tariff news dominates market attention? And I'm not talking about financial news, but do you think it dominates market attention next week?
Well,
here's my premise. Do you want me to give you my premise first, or do you want to answer?
I don't see it. Hold on a second. It's on the table all the time now, which is unfortunate. But next week is a shortened, like April.
4 days because of
April expiration. It's a little shortened.
Expiration's Thursday.
There is an old saying:
big earnings week.
Buy Passover, sell Easter.
Mm-hmm. The premise is, can you do any more retaliatory damage than like 100, 134, 150%? Like at some point, it's a moot point.
No, it's a moot point. It's.
You get what I'm saying?
It's actually stupid. Yeah, it's completely ridiculous already at 150%.
So
I don't even know what that means.
The tit for tat.
Yeah. Let's do. You go 150. I'm going 250.
Right.
Like
1,000,000%.
Exactly.
The greatest meme I saw is
you've already destroyed the demand at some point of no return. So the numbers become silly at some point. It doesn't even matter.
The greatest meme or tweet I saw was Donald Trump got us into a math contest with Asians. We are so
so dead.
I mean, I love Twitter. I mean, I just think it's so funny when people get funny about it. I don't like it when it gets something else, but I love it.
Yeah, I mean, it's so ridiculous. So I'm curious, Vic, because you're basically, I mean, you're the closest thing we have to a man on the ground in China. You know.
Yep. Yeah.
I would have thought a lot of things for my professional resume. tastylive Asian correspondent. I did not see that coming. I didn't see that coming, Tom.
Well, you know, there's a lot of good things about that. I'm just curious. I know Singapore plays like a very middle of the road stance on everything, but there is a huge Chinese population. I'm just curious, like, kind of what is the general consensus from that part of the world with respect to all this? I mean, are we looked upon as fools? Are we looked upon as, like, what's the deal?
Jesus, you're putting a lot on me. And I'm sure there's maybe some Singaporeans listening. They're like, this guy is our representation. this is the guy who's going to speak for what we feel about this particular topic. So let me be a bit careful. I would say Lawrence Wong, he put out a video. And so I'll just speak to what Lawrence Wong
I don't know who Lawrence Wong is, do I? Or should I?
You should. I mean, you should. The leader of Singapore, effectively the prime minister, just put in place by the previous one. And he effectively said, he spoke to the gravity of what this move meant from Singapore's perspective, that it was a re-engineering of the global order, of global trade. He said this is a system that the U.S. itself had designed, and that, he reiterated their stance to trying to remain neutral, things of this nature. But I mean, it was a message with a lot of gravity towards the public about how serious this move was, how it can impact Singaporeans, how it can impact the economy, and how it impacts geopolitics and how they navigate this. It's a city-state of 6 million people. Everyone has to sign up. All military-age men have to sign up for the military. And so, things like this that create a lot of volatility, it's clearly not a good thing for Singapore. But yeah, just a gravity message, and it's a system that the U.S. itself had designed, and so he's basically saying we don't get it. In a way, we don't understand it, but these are the cards.
I think that the chorus of boos is getting louder and louder, and the not just globally but domestically too, and it will be. So I don't think, to answer your original question, I don't think that the chatter goes away next week, but I do think that at certain levels, we're getting to a certain spot in equity prices and in bond yields, and in other things like the price of gold, like the U.S. dollar collapse. I think we're getting to spots where people are starting to. They don't care. What happens is initially everybody cares about the reason, and then they care about price, because it's all fine, until the whole someone gets punched in the face type thing. Everything's fine until bonds crash. Everything's fine until stocks crash. Everything's fine until, everybody can talk about all the tariffs you want and this and that and tit for tat and blah, blah, blah. But when the US dollar crashes, then and your numbers look ugly, or you can't do 30% of your business because nobody wants to trade with you, you
sing a different tune.
You sing a very different tune. And we have to stop fooling ourselves here. This is probably based on current prices. I'm surprised the price has been as extreme as it's been. And so I think based on the extreme price, nothing else, just extreme price, forget about all the politics and just talk about based on price. I think the suggestion is very clear that this is not working and that something has to change. I think it's very, very clear.
Well, I asked the question because I wonder whether setting the table for what's coming up next week, does it matter? You got through JP Morgan earnings, Wells Fargo earnings, and a slew of others. Like, does it matter? We're going to have some more bank earnings next week. Your key themes are going to be more bank earnings with Goldman Sachs on Monday, Bank of America on Tuesday, Citigroup, and a handful of others and smaller regional banks towards the end of the week.
You start getting the United Airlines of the world too. American Express gets thrown in there too later in the week, and a lot of other banks. You're correct.
Yeah, and then you're going to get a little bit more Fed squawk. You've had Fed squawkers all this week. You're going to get a few more next week. I know you guys don't really care about that stuff, no. And I don't know that it's necessarily market moving. I don't
think it's market movers. I think that the key here is just the underlying. The major, I don't think you need to go that deep. This is the bond market is telling the story, the U.S. dollar is telling the story, and the stock market is telling the story.
And volatility is telling a story.
And volatility.
And I think your market
is
going to change with the wind because pricing is going to move so much. And my opinion has changed so much with pricing, but volatility stayed consistent.
The fear index is not sustainable at these levels, and I think
the backwardation is sick.
And I think that
we're still in a pretty deep backwardation. Yeah.
I think when you look at volatility where it currently is trading, and you think about that from who we are. We're not a third world country,
right?
This is U.S.
bonds
markets
are trading like an
Netflix comes out on Thursday.
Market.
You start getting those guys too.
Yeah, I don't think earnings are going to play into this, but this is a very we're walking awfully close to the edge on the ledge here. And so I would just be, I think we have to respect that. And I'm just like my concerns were last night with you and in our discussion, things like that. I wonder whether people that are making some of these decisions understand.
Let's not go there.
I just wonder whether we understand the risks involved. That's all it is. Because volatility is telling you right now that the risks are greater than
they can see pricing. They don't have to even read volatility. I mean,
I know.
And the way the market's
inflection
moved,
point
even
of the cycle,
an imbecile can see that, right? I mean, whoever we're talking about.
I
would agree with you that. Oh, go ahead.
I think Janet Yellen gave an interesting talk last night, and she said basically, it's rare that we get self-inflicted volatility expansion. It's rare that you get self-inflicted volatility expansion. That's all there is to it.
I know, but we can't. I mean, Janet Yellen was clueless for so long. I mean, because we like something she says. I'm just bringing. She echoed a sentiment that you agree with. I would go with.
No, I don't care which ex-Fed chairman it is. It's self-inflicted volatility expansion.
I try, Victor. I really do try, man. I really
self-inflicted volatility expansion is a rare thing in America.
I mean, so many times. Listen, bonds are lower. Let's talk math. Bonds are lower. Bonds go lower. Rates go higher. Can't cut rates when bonds are 112 and change, no matter what anybody says.
Do you have to raise them?
You would have to raise them.
No.
Or yes, you would have to raise them. I would be.
I agree with you. I agree with you.
Okay.
No way.
Forget about what anybody else said. Victor, I'm going to give you the last word. I've got a bunch of phone calls before we get to the opening bell. I'd like to get to them. They've been patient and holding.
Okay, 2 quick points. There's no way they're going to raise rates anytime soon. They've already signaled that they're looking at any inflation that comes as potentially transitory. Jerome
then you
Powell
get a rip
used
your
that
face
word.
off rally bonds.
He tries to signal to the marketplace that they might look through it. Whether that's right or wrong, I don't know, but they would need a lot more work, I think, to get the market in a place where they start talking about, well, let me not say that. I don't think they're there yet. That's one. Number two is I do agree with you. Big earnings week next week, but I do think at the inflection point of the cycle, what these companies did for the last 3 months, I do not think investors and markets are going to care about at all. I think you're going to see a lot of CEOs who are going to kitchen sink just the same way Walmart did where they dropped their full year guidance. I think you're going to see more of that. There's no reason for CEOs to try to be a hero here and try to predict an unpredictable environment. So I would expect more of that. Watch home builder data. We got home builder confidence. Mortgage rates are still around 6.6 in some areas, 8 in others. Home builders been on the floor. DHI and a few others are going to be reporting. I know you don't love those as tradable instruments. But as
They're
a
pretty
theme,
thin. Just so people know, home builders are. I mean, I don't trade them not because I hate the space, but because I don't. Is there anything to? I don't think
That
there's
is
much
just
there,
in the
Vic.
market.
Yeah.
But if you're a long time hold and you're looking to do something, I don't hate it there.
The reason I say this is in 2022, given that volatility, home builders got spanked first and they went on a nasty rip for 2 years after that, and they moved first. So I think you keep your eyes on home builders along with credit, JNK and HYG. Thank you, gentlemen.
You got it, brother. Appreciate
Thanks.
your time.